Welcome to the Brokers Lounge with Eddie and Carlo. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you want to book a free call to discuss your personal situation.
Welcome to another episode of the Brokers Lounge with Eddie and Carlo. In this episode, we'll be talking about everything to do with refinance. What is refinancing? When's a good time to consider refinancing? The pros and cons and everything in between. So I'm actually excited about this episode.
Yeah, it's going to be a pretty full-on episode, isn't it?
Yes.
Because it's obviously a hot topic with a lot of people. You know, the cost of living pressures that everyone talks about, and how do we overcome this? And one of the first things that people look at is what are their monthly costs, and home loan repayments are typically the biggest part of most people's monthly expenses. So the first thing they look at is, do I look to refinance or get a better deal out there? So it's lots to cover today, that's for sure.
Absolutely, and especially on the back of inflation cooling down a bit this week, and few banks cutting their rates. So probably we can see potential for good refinancing deals coming soon.
Yeah, it's it'd be good to have, for consumers to have the ability to potentially get a better deal than what they're currently on at the moment. A lot of them their hands are being tied to a certain degree because they may be on a higher rate, but there's not much they can do at this point in time. So fingers crossed that we can keep inflation under control and interest rates stay the way they are, and obviously start to track downwards as well. Yes. That's probably the main thing for us. So
that's it. So I guess we'll start. What is refinancing and what actually falls under refinancing?
Yeah, I think one of the misconceptions that people, I should probably go along the lines of, people think there's only really one type of refinancing, and that's just moving from one bank to the next.
Yep.
In actual fact, there's probably two parts to refinancing. One is external refinancing, like I said, moving from one bank to the next. The other one's actually internal refinancing, which
absolutely.
We do from time to time, where clients will, there will be a need for us to be able to restructure their facilities with their same lender.
Yep.
And if it makes more sense to do so, then obviously that's the first port of call that we go with our clients. So, Eddie, what do you reckon? What would be the top reasons why someone would look to refinance from their current lender to another lender?
To another lender? Well, look, obviously the interest rate is the biggest factor here. Like a lot of people just want to save on those repayments, especially in current interest rate market. So I would say the biggest factor is interest rate, just moving from one lender to another, but on the basis of getting a 0.5% better, which would work out to be a decent amount per month in terms of repayments. But also there's other options that people usually consider when they're looking to refinance from one bank to another, external refinance. So usually if people are looking to release equity, let's say, and the bank they with, the policy that bank has does not encourage or does not allow for the customer to release equity based on their income or based on their personal circumstances. So they might have no other option but to move from one bank to another. So I guess interest rates, policy, what else would you add there?
Yeah, I think just to expand on the policy, we see it a lot with the variances from one lender to the next in terms of what they can and can't approve nowadays. I think we saw one not that long ago with regards to clients who received decent bonuses.
Yes.
And the ability of some lenders to just rely on the most recent year's bonus, which is great from our client's point of view. Whereas you got others who are saying, well, we really need to see it over the past 2 years.
Average it out as well.
Correct. Yeah. And I think the other thing as well with wanting to refinance from one lender to the next, a lot of it's got to do with the service that they're currently getting from their current lender.
Yes.
Banks are all very similar in terms of their products, their policies, their pricing, But quite often for clients, it comes down to the service that they're getting. A lot of them are really disgruntled with potentially how they've been treated in the past by their current lender. So sometimes that's a good, point for them to sit back and go, well, you know what, I not only want to get a better deal for myself from an interest rate point of view or fees, but I want to go with a bank that's going to look after me and really want to bank me as well. So.
Also, I see a lot of people big on internet banking and the app for the bank. So
yeah, that's a big one, isn't it?
Yeah,
it's amazing. I never thought that people would actually be so concerned about, the app that the banks use for their internet banking. But
younger age care about
like
that
me.
stuff.
Yeah, you're talking about? Okay, thank you.
Yeah, I see a lot of the younger ones. They're very big on the app and how it works and how easy it is to navigate. So that's a big thing that banks need to invest in. So yeah, like you said, service, and I think that falls within that service the bank that can offer to retain customers, especially the newer generation.
Yeah, and just going back to that equity release piece as well, we've had a few clients recently where they've wanted to release some equity from their property and invest into maybe another property or cash investments, whatever it might be. But they've had issues when we've gone to do a valuation with their current lender.
Yes.
We are seeing a lot of variances now between the lenders in terms of what they come back with. They have different ways of valuing properties. That's, I think it's another reason why people potentially look to refinance with a different lender.
Yes, and that's I guess the part we play as brokers, being able to get few valuations with different lenders, and on the back of that, if it's worth moving or just staying where you are. So yeah, that's a big part, 100%. I guess also it's worth discussing what's the cost involved in refinancing, because there's a bit of misconception out there that sometimes it's going to cost you a lot to move from one bank to another. So what are the costs?
The main one's obviously going to be the exit cost or the exit fee that your current lender charges.
Yep.
It's not too bad really. It's on average probably about $350 for each of the banks, which is not too bad. The thing that a lot of people do get caught up in or forget about is if they're on a fixed rate. Obviously, that's a big one, because the break cost to get out of a fixed rate loan nowadays can be in the thousands of dollars. So you've really got to make sure that from a cost versus benefit point of view, it's going to be worth your while.
It's feasible,
And it's obviously where we jump in and say, well, we can do that analysis for you. We can say, well, if we can save you X in interest, how does that compare to what it's going to cost you to actually move across?
That's right.
You've obviously the other things as well as government fees.
Yep.
The cost to actually register your mortgage on your current title, another few $100s again. So before you know it, you've probably got $500 to $600 worth of costs that you need to make sure that you can actually recover in not too long a time frame as well. So you don't want to be saving
$20 a month,
and cost you $600 to move. So it's got to be definitely worth your while to do that. So
like another important point, I guess, it's not always about saving. Like if moving from one bank to another or from one lender to another aligns with your strategy, with your structure, with what your bigger goal is. Sometimes we do that, even if it's not a better rate. Sometimes we move to different lenders for a worse rate or a higher rate, but it aligns with the customer's objectives and long-term plan.
And that's obviously something we're pretty big on here at Link Wealth, is about the long-term wealth creation strategies for our clients, and how do we put them in a good place not only now but down the track as well. So you've got to look more medium to longer term with clients.
Bigger picture.
Not just transactional, like how do we deal with this situation right now? It's like, what are your longer term plans? Could be building wealth through property or other investments. Let's make sure you get yourself set up with the right type of lender now and into the future as well.
Absolutely, 100%. And if we can manage to, I guess, tackle all these in the best way possible, that's you've hit the jackpot. Like best rate, best product, and aligns with your long-term future, which we try to make all these work, then it's great. But sometimes circumstances don't allow you to hit all these perfectly, so you just gotta find the best way possible.
I think just on that point as well is, that really does highlight once again the importance of dealing with all the important people in your life when it comes to wealth and wealth creation. We link in really well with, pardon the pun, the link, but with the advisors within our business, accountants as well, so that everyone is really on the same page.
100%.
And everyone's not, we don't have an accountant or a financial advisor saying, we want to do this for you and get you to this end goal, and you've got a broker who's doing something completely different.
100%.
It just doesn't make sense to do.
We're all on the same strategy. I see it sometimes where accountants usually push for tax strategies, saving tax, and then the advisor is pushing for wealth creation, which does not need to have tax savings. So it can be different, and then we fall in the middle. It's like, what do you do here? So having all these three working with you for you, it definitely helps a lot and makes the process a lot smoother.
Yeah, exactly.
I guess one more thing to add on external refinances, which is quite big out there, is debt consolidation, where a lot of people, if you've got a $50,000 car loan here, you've got $25,000 credit card debt, bits and pieces, they all add up to 70, 80, 90K, and you're paying like $3,000 in repayments a month. So sometimes it's not ideal, but instead of paying that $3,000, you can refinance it into your home loan, do the debt consolidation, and you're paying $400 compared to the $3,000. Now, yes, if you say, I'm going to be paying that over 30 years with interest and all that sort of stuff, I'm going to be paying more. Yes, that's true, but then at the same time, you need to do what's best now in terms of your cash flow if you're not keeping up. And then maybe you can do different strategies where you have that on its own and on a 5-year term or 7-year term and try and pay it off. So that's another big thing we do quite a bit. It's that debt consolidation.
I guess it goes back to the bigger picture scenario, in that you've got to just look outside of what you're wanting to achieve right now and say, well, how do I make my position a lot better?
Yes.
And for a lot of clients who do have, short-term car leases or whatever it might be that are chewing up a lot of cash flow, the ability to be able to actually refinance that and consolidate that debt into a home loan. Like I said, yes, you are potentially dragging it out over a longer period, but that may open up other avenues for them to be able to borrow more to purchase another property that they may not have been able to do. And if you look at the bigger picture, they'll create a lot more wealth going down that pathway rather than saying, well, no, I can't afford to buy this property now because I've still got this car loan that I want to pay off over the next 2 years.
Exactly, 100%. And that's why it's always up to your personal circumstances and what works for you. So what works for me might not work for you. So that's why really understanding what your objectives are and what you're trying to achieve is key here in knowing and understanding, so we can recommend the right way and the right structure. If we move from external refinances into internal refinances, so we do quite a bit in that space as well for our existing customers or sometimes for new customers. So what are internal refinances and when do we look at them?
Yeah, I think to preface all that, first and foremost is we always want to make sure that we're doing the best thing by our clients, and sometimes that doesn't always mean refinancing to a different provider or a different lender out there. It can actually sometimes mean stick with your current lender. You've got the right type of product there or the right type of price. You're happy with their service. So sometimes it means actually better to go with your current lender and work with them. So internal refinance could be something as simple as you changing your strategy. You may have a loan that's principal and interest to your home. You want to then turn that into an investment property. And the recommendation might be from an accountant or advisor to actually switch that to interest only. So the need to actually move from, say, principal and interest to interest only, typically the process is going to be similar to like doing a normal refinance, full application. The bank wants to reassess everything. So, that's one example of where we need to do an internal refinance as such. Any other?
I guess,
examples?
like you said earlier, it's just if your current lender can match what's out there, can provide you with the right product that we're after, and it makes sense to stay, then absolutely that would be the first option. If we can get something better somewhere else and it makes sense in terms of feasibility and you're going to be saving a bit and the overall strategy, then by all means we're moving, because you've got to look after yourself and what works for you, regardless of what the bank and the lender is. And that's something to consider in your 30-year terms. Your strategy changes along the way, your circumstances change along the way, and to me personally, having that mindset of I'm just going to take a 30-year mortgage and I'm just going to keep doing those repayments over 30 years, it does not really work for me. So it's always finding bits and pieces, shortcuts to make those extra repayments, move from one product to another that's better, getting a bit extra advantage, utilizing the offset or doing fortnightly repayments, little bits and pieces, and you could knock off 10 years off your mortgage, without knowing it. So it's just taking advantage of every bit we can.
Yeah, and it comes back to that constant review of your lending facilities. It's not nowadays, we're not in an environment where you can just set and forget. You've got to be constantly reviewing, evolving, and improving your situation as well. So I think one of the things that we get asked a lot is now a good time to actually refinance? What do you reckon, Eddie?
Well, yeah.
I don't have the crystal ball, but there's probably a lot of.
I thought you did.
I
give the
tried
impression,
to, but there's a lot of research that obviously goes into what we do for our clients and determining whether now's a good time to actually refinance. So, what would probably be the first thing that sticks out, and that comes to mind?
I think what we discussed earlier all falls into place when we're considering if it's worth refinancing or not. But from the get-go, if you're on a 6 point, like in today's market, we're in 30th of August 2024. If you're on a 6.5% interest rate for your owner-occupied property, there's definitely better options out there. If you're on a 6.7 plus interest rate for your investment property, there's definitely better interest rates. Like few banks have cut their rates over the last couple of weeks. So that would be the first priority. And then obviously everything else falls into place. What's the strategy? What's the aim? Like we work with a lot of people who are buying their first or second investment property. They want to tap into equity. So valuation plays a huge role. Policy plays a huge role. How much equity can we get from your existing property to utilize that for the second or third purchase? So all these come into play. But I guess the first one you always look at is what's your interest rate, what are your current repayments, and what, like the overall strategy, we can, change things to make it work better for you. So is it worth? Maybe, depending on your circumstances. I don't know if you've got a different way of looking at it.
No, I think I'm pretty much similar to yourself, Eddie. And the interest rate's obviously the first thing you're always going to be looking at, because you want to be putting your clients in a much better position.
Yep,
that's for sure. So, and everything else pretty much will follow that as well. So,
yes, 100%.
Yeah. So, Eddie, assuming now's the right time, if you want to put it that way, to refinance. Before we get into what are the actual steps involved, probably a good opportunity to tell our listeners out there maybe a really good example that we've had recently where we've been able to help the client refinance, whether it be that you've saved them thousands of dollars or put them in a better position structurally. Is there anything that comes to mind that you've worked on recently?
Yeah, we do that all the time, but I guess one of the most significant ones so there's something called the loyalty tax where...
Oh, yes.
Yeah. So
I think I'm still paying it right now.
Yeah, exactly. So the longer you stay with your lender, that rate would be creeping up without you knowing. And unless you go to the bank and to your bank and tell them, I need a discount or whatever, they're not going to give you a discount. They just...
So they don't reach out and say, hey, Eddie, we'd love to offer you another 0.5% off? No.
No. Nope. So you're going to have to call him and chase him up to do that. So I had a customer who was on 7.8% interest rate, and it just thought it's okay, like interest rates are high, whatever. Yeah, and you don't look at it, you don't follow it up. So yeah, we managed to save him about 1.5% of his interest rate. That's huge, in terms of savings. So that's like a significant one. And yeah, like we do the debt consolidation or the equity releases where customers go out there and buy their second or third or fourth investment property. So yeah, it's
Yeah, I think I had an example actually recently as well where I had a client similarly paying probably way over what they should have, but that's more so of a legacy from when they applied for it. Their loan to value ratio was a lot higher.
Yeah.
So they're typically paying a premium on their interest rate because they had to borrow a lot more.
Yes.
And it came about simply because they were interested to see how much their property might be worth. We ran a couple of valuations. Valuations came in a lot lower than what they were previously. Before we knew it, we had them down to a really good loan to value ratio. And as we know, the banks typically price nowadays according to that. So once again, we were able to save this client close to 1% off their current interest rate purely because we were able to do another valuation for them, no cost to them.
Yes.
It's great. The banks are paying for the cost of these valuations and the clients are benefiting from it. So
absolutely,
really big win-win for the client to save that amount of money purely off the back of the benefit of having their property going up in value over time. So,
and that's a very important point. I guess we see a lot of people who have to do a low doc to get into the market or do something due to their financials not ready, or they've only been trading for 1 year or whatever reason. And usually with low docs, you're seeing a higher interest rate.
Yeah.
And then 1 year, 2 year into the process, and they don't relook at it, but like you can actually go back to full doc and get a much lower interest rate. So that's something also to be mindful about.
What's typically the difference between the interest rate on a low doc versus a full doc loan? Just on average?
Probably a bit percentage, 1%.
So definitely worth your while. If you look at the average loan, $500,000-$600,000, 1% is massive.
100%. Like I've got one, it's a $1.4 million loan that I did a few weeks back, and it was on a 7.45% and got that down to 6.3%.
That's awesome.
So yeah, absolutely always worth checking. And like I said earlier, it all falls within your long-term strategy. Yeah. So you need to either constantly stay on top of that or trust someone like to do that for you, of course. To do that for you and make sure, you're well positioned in the market. Your interest rate is good. It's within the average. Your circumstances align with your strategy and with your future. So it all helps. Yeah, definitely.
And I guess once we've got to that point where clients have agreed that yes, now's the time to be actually refinancing, we've been able to source them a better deal. I think one of the misconceptions, if you call that, is what's actually involved in a refinance. People think it's probably quite easy because they've already got a loan and they're just going to move across to another lender doing the same thing, dollar for dollar.
It makes sense.
This should be done in 3 days? Yeah. Probably a good idea to probably just talk people through what actually are the steps to actually go through a refinance.
Yeah, absolutely. Like you said earlier. So I get some people saying, we just need to tap an extra 100K. That's no issues because we already bank with the bank. They know everything. But no, you have to go through the whole process, internal refinance or external refinance. If you're changing the term, the loan amount, the structure, anything, you have to go through the whole process of providing your income documents, your personal statement of position in terms of assets, liabilities, everything, and we have to assess the full application and make sure servicing is there. There's no issues. So it's a full process, I guess, that you have to go through and ensure that you can actually afford it. So
I guess we break it down to credit critical refund or issues or non-critical credit critical issues. So if we look at what are non-critical items, if a client has an interest-only loan, they want to move it to principal and interest.
Yes.
Doesn't need to go through a full reassessment, which is great. Or you want to add an offset account to your loan, assuming that the loan actually has that as a added feature. Or you want to add a package. Banks got all these different packages they want to add to it. So they're typically all the stuff that you don't need to go through that full credit analysis. Pretty much everything else, you've got to do it. So, got to be mindful that the refinance process isn't something that's going to be done within just a few days.
Yes.
We're still talking a few weeks, but by the time you collate all the information, we do all our research in terms of finding the right lender and presenting those recommendations to our clients, to then actually submitting the applications as well.
Yes.
And going through that whole assessment. So.
And also getting the evaluation done. Sometimes that alone takes 2 to 5 business days, depending on availability. So yeah, there is a process involved. And like you mentioned earlier, interest only to principal and interest, that's not an issue. You can do that without providing the documents needed. If you are to go from principal and interest to interest only, then that's a full assessment thing. So you have to provide everything.
Yeah, it doesn't sound like much, does it? But in the overall scheme of things, it actually is quite critical.
And I guess that goes based on APRA's recommendations in terms of minimizing interest-only loans and making people pay down the principal. So banks try to make that harder if you're going to interest-only, to encourage people paying down the principal. So yeah, that's very important for noting the credit and non-credit critical. I guess it's also important talking about some misconceptions that we see around refinances. You want to take us through some of the misconceptions we see?
Yeah, one of the ones I made a note of this earlier on was around the loan term.
Yes.
And by that I mean, people have this misconception, not everyone, but that the loan term needs to actually replicate what they previously had, or vice versa. A lot of people say, well, I don't want to actually have to go to another 30-year loan term because I'm refinancing, so that means I'm going to be taking a lot longer to repay my loan. We can make that loan term whatever we want it to be when we go to do a refinance. So if you wanted to replicate exactly what you had previously to ensure that you're going to be repaying that loan in that same similar time frame and hopefully better, then we can do that as well. So yeah, that's one thing that a lot of people go, oh, yeah, I'm happy to refinance, but geez, I don't want to reset for another 30 years. I've only got 10 years to go. Well, we can actually make that new loan term the same. So
100%. Yeah, I see that quite a bit. And I guess it's important also to talk about, sometimes we increase the term of the loan. Like you get people they're on 17 or 18 years in terms of the term, and then we want to refinance, but their objective is maximizing their cash flow because they're looking to buy another property. So extending that term back to 30 years will allow you to borrow more because your repayments are less over 30 years. But then you can choose to do extra repayments and still pay that debt down in 17 years. But from a servicing point of view, having that 30-year term can help you quite a bit with borrowing more money that you might need. So it comes down to going back to your circumstances and what works for you and what needs to be done in terms of structure. So yes, that's very important. What's some other misconceptions you see out there, Carlo?
I had one recently where a client had actually gone down the process of getting a refinance and been declined.
Yes.
And they pretty much said, well, I guess if I've been declined, I can't really get refinance anywhere else now. And so that's one misconception, that if you've been declined once, then that's it. There's no tomorrow for you.
It's like on your police check.
Exactly right. So it's, definitely if you have been declined in the past, that's not to say that we can't find another home for you when it comes to refinancing a loan. So it's a weird one, but yeah, I've heard that a few times from clients who think that, they're stuck now because they've been declined by going to one lender. Now that one lender may have had a certain policy that just didn't quite suit them perfectly, or
they do it yourself through one of those online banks sometimes.
Exactly right. Yeah. So it's always important to engage your broker and make sure you have that conversation with them. be upfront if you've gone down that process of getting a refinance and it hasn't worked out for whatever particular reason. Let your broker know exactly what actually happened.
Yes.
Let them do the research. Let them do the workshopping with another lender to make sure that it's all going to, go through a lot more smoothly the second time around or third time around, or whatever it might be. So
100%. Well, look, I think there's a lot more to talk about, but we'll come to those in the coming episodes. So we've covered quite a bit today. So
hopefully everyone's enjoyed today's episode, and like Eddie said, there's obviously lots to discuss when it comes to refinancing, and hopefully we've covered a fair bit of that today. As per normal, you'll find our contact details in the show notes. We once again welcome any feedback you may have as well. Don't forget to subscribe to this podcast for more tips as well, and we'd obviously appreciate if you leave us a lovely 5-star rating as well. But until next time, Eddie, thank you.
Thank you, Carlo.
And thanks everyone for joining us.
Thank you. See ya.